I'm Scarlet. This is ETF IQ, where we focus on the access, risks, and rewards offered by exchange-traded funds. Tesla on a tear. Shares of the electric car maker shift into hyperspeed. We look at the ETFs with the most exposure. Don't look now, volatility is back. Sylvia Jablonski of Direction tells us what the return of price swings means for the use of leveraged ETFs. And when playing it safe pays off, XAR's performance the past decade proves the best offense is a good defense. So I'm here with Bloomberg's ETF authority, Eric Balchunas, and usually we start with flows, and we are going to get to that, but you might have noticed that our program is now called Bloomberg ETF IQ Americas. It's a big week for our ETF coverage because we're launching an ETF IQ Europe edition with Francine Lacqua.
Yeah, it should be exciting. Europe just saw record flows. It's good timing. It's going to be all original content based on that market. I'm excited.
And of course, they're probably going to bring up flows, which is where we're going to go to now as well. What are you seeing?
So I'm seeing a massive investor doing something, and I'll show you what I mean. Look at the top two flows. It's IVV and VU, which you guys all love and know is the S&P 500 ETFs, typically used by advisors. Look at the amount of money. Now, normally I'd think this was tax-related or operational, but rebalancing should have happened in December. So this is likely, my theory is, I call Merrill Bigfoot because they're a model portfolio of about $100 billion, and they own more than that of each. My guess is they've allocated more to the S&P. I could be wrong, but clearly it's a big fish doing something here. The rest is a little more sentiment read. You're looking at a little hesitation. You got bonds in here and gold, but largely people buying into the market, nothing too bearish in there. Let's look at the outflows. Look, there was a knee-jerk reaction earlier, and you see some outflows from some of the trading crowd favorites like SPY, XLF, IWM, but largely you can see money coming back in over the last couple days. And let's look at the past 24 months of ETF flows, because I want to talk about this trading crowd and the retail crowd together. ETF has taken in $2.4 billion a day for the past 3 months. If you added up January, December, and November, you would get a record quarter if that were an official quarter. Now, normally ETFs take in $1.2 billion a day, so they're taking in double the normal. Scarlet, because the trading crowd is excited. So as long as they're excited, you're going to see double the flows. Something spooks them, they're going to pull back, and we'll go back to about $1 billion a day.
All right, new year, new trading environment. Let's bring in Sylvia Jablonski. She is Managing Director of Capital Markets at Direction, and Claire Ballantyne, a cross-asset reporter for Bloomberg News. Sylvia, let me start with you, because if anybody knows the trading crowd, it is you guys at Direction. Based on what you see and what you've heard from your clients, what does the trading crowd make of the fact that U.S. stock indexes are no longer moving just 0.2% on a daily basis?
So the trading crowd is very excited about it. If you look at the flows in various 3 beta ETFs, which we're sort of known for, you've seen upwards from 100 to 200% change in daily volume, 20-day daily volume. So particularly of interest are the China funds. All the China and the bull and bear funds have just been whipping around 100%, 200%, which is actually great to see, because that means that investors, last week when we got the news of the coronavirus and we really saw the pullback in that particular region, we saw people flocking to the bear funds. And then when we saw sort of the reversal on Monday and Tuesday, we saw it go back into the bull funds. So I think that traders who looked at that, short-term opportunity gathered some alpha in their portfolios and then sort of moved on when the market started to recover. Other interesting trades along the same theme, tech went back up in terms of volume. Eric, I saw you tweet something about, tech L 10,000% since inception. So
it's ridiculous.
It's
10,000% since inception. It's 13 times.
Back.
It's compounding effect. It's weird math that works in your favor occasionally.
It does. Low volatile trending market. That's what it works really well.
And just talk yin and yang. We looked at, you have a bunch, by the way, you've just exploded with all these China ETFs. Yin and Yang are the famous ones, but you have these other ones, and they're all seeing major volume increases. Is this just, look, if there's a volatility somewhere, you're going to see your crowd come in and start to play this, right? And so describe what's being played here by these 5 ETFs.
Sure. So for Yin, Chow, and CWEB. So Yin is the China H shares. So they're basically the Chinese stocks that trade in Hong Kong, and Chow is the A shares. CWEB is basically China Internet. So what happens there is that last year, if you look at those products, Yin, for example, was up over 20%. CWEB was up double digits. And what happened there was it was a good story. We had a phase 1 trade deal. We had a lot of good news about, the largest growing middle class population, the second biggest biggest contributor to the world economy. And what happened since is essentially the coronavirus. A lot of the local businesses are shut down. It impacts A shares more than let's say H shares. And investors went in, looked for those opportunities around the up and down volatility and pullbacks of the market.
All right, of course, coronavirus is top of everyone's minds, Claire. It threw everyone for a loop, and for a while it seemed like investors couldn't really make up their mind as to whether to be risk on or risk off. What are you seeing?
Yeah, we're really seeing news of the coronavirus really impacting ETF flows. So first we saw big inflows into ultra short income ETFs, for instance, JPST, as investors were searching for less volatility. Then a few days later, we're sort of looking at funds tracking the S&P 500, some seeing big inflows, some seeing a big outflow. So it really highlights how investors aren't quite sure what's happening.
Absolutely. And of course, another big story this week is the explosion in Tesla shares. We're really not quite sure what the catalyst is. Maybe it's short covering, but apparently a lot of people, including Steve Eisman, have already covered their shorts.
Look, everybody has a pain threshold, and when a stock becomes unmoored from valuation because it has certain dynamic growth aspects to it, and it has cult-like aspects to it, you have to just walk away.
Steve Eisman, of course, known for shorting CDOs before the financial crisis.
Yeah, and speaking, Tesla's return is like a freak of nature, in a good way for some ETFs. Which ones are seeing the most pop here, Claire, from this?
Yeah, so unsurprisingly, a couple of auto ETFs are really benefiting. So a ticker CARZ is really benefiting. A couple of clean energy funds.
Makes sense.
One of the biggest ones is the ARK Next Generation Index Fund. That has about a 12% stake in Tesla. And about half of its gain this year can be attributed just to owning Tesla.
Yeah, Sylvia, you need to come up with a triple leveraged Cathie Wood ETF. I think there's a market in that. Speaking of which of the leveraged ETFs you do have are getting a little Tesla pop?
Yeah, so I actually think that it's sort of thematic. So it's playing whether or not it necessarily holds the ETF within the index. What we're seeing is a pop in UBOT, which is AI and robotics, and also technology. So I think that people sort of equate Tesla to technology, artificial intelligence, and robotics. And we've seen some short-term pops in that ETF. And also, again, going back to coronavirus, what happened in the market? They were on sale. On Monday, they were on sale. They're, Apple's back up. A lot of those names just really popped those indices.
Sylvia, before we go, I got to ask you really quickly. ESG is all the fad here in 2020. I shouldn't say fad because it may very well be a sea change here. You guys have come out with some leverage funds on ESG as well. Explain very quickly how it's different from what's available.
Sure. So these are a little bit different in sort of a few ways. So our ticker is ESNG, and what we do is we have a 150-50 structure, which allows you to have enhanced exposure to companies in the MSCI USA Leaders Over Laggards Index that have positive ESG characteristics and are also trending upward towards those things. So it's momentum and positive ESG scores. They're rated like bonds, AAA all the way to CCC. The top names are in the top. So the bottom basket is essentially the companies who aren't doing so well in that space. So sort of the less positive corporate governance, social governance, gender equality, things like that. So they're shorted on the leg of the 50. So it's 150-50, it's 100% exposure. So it's not leverage in the same way. It's meant to be long-term buy and held, but it allows you to get a real enhanced exposure to the ESG factor. So it's a little bit different than the others because you're actually shorting the companies that you don't think are the top ESG names.
So you punish basically the bad actors as a result. Sylvia Jablonski of Direction, great to see you again.
Thanks for having me.
Thank you so much. And of course, Bloomberg's Claire Ballantyne as well. Now coming up, we speak with Ed Rosenberg of American Century Investments, which is among the first asset managers to be part of the ant invasion in ETFs. And speaking of ESGs, I have one fund that we want to highlight this week is the iShares Janzi Social Index ETF, trading under the ticker XEN. It is one of Canada's oldest ESG funds, and investors are piling in. It posted a record month of inflows for January. A reminder, by the way, that you can catch all our charts on the Bloomberg at GTV Go. This is ETF IQ. I'm Scarlet. This is ETF IQ. Let's take you through the ETF Life Cycle, which has three main stages. Step one is the filing. Cabana Asset Management partnering with exchange-traded concepts on a suite of 5 target drawdown ETFs. These will be actively managed and invest across asset classes. Each of the funds will attempt to limit drawdowns to 5, 7, 10, 13, or 16%, depending on the fund, but there is no guarantee. Step 2 is the launch. Direction plays it safe with its Flight to Safety ETF. Ticker FLYT will be actively managed and invest in government securities, including treasuries, money market funds, cash, and other short-term bond funds. And for some, the final stage is liquidation. The Wisdom Tree SIBO Russell 2000 Put-Right Strategy Fund is shutting down. Ticker RPUT was passively managed and followed a traditional put-right strategy that writes at-the-money put options on the Russell 2000. Wisdom Tree still has an active, or I should say an S&P 500 version of the strategy that's still on the market under the ticker PUTW. All right, now let's get passive-aggressive and track the tensions between active and passive investing. After years of losing ground to passive, active managers are intent on getting their mojo back. And one way of doing that is embracing the ETF wrapper. American Century will be among the first asset managers to launch an actively managed ETF that doesn't share its secret sauce. Ed Rosenberg, the firm's head of ETFs, joins us now. Ed, great to see you.
Thank you for having me.
Now, American Century may very well come out first in the ant race, the active non-transparency race. And we know you filed for a bunch of funds, value, growth, as well as sustainable. What's your thinking on why these strategies are suited for non-transparent disclosure funds?
So let's start off with the value and growth strategies. The purpose behind them is you're bringing forth what I would call the best ideas of a portfolio manager that they could be more concentrated. And so the point is that it doesn't matter now when you're 5 million, 10 million, but as you get bigger and you make changes, one, you start worrying about free riding. So do people start mimicking the portfolio if it's as successful as we hope? And the second part is, do people start seeing what you're trading? And so using the example of maybe we own Apple in the portfolio and it's the top holdings and it goes from 3.5% to let's say 2.5% one day because we can't trade out all of it, and the next day it goes to 1.5%. Can people front run those trades by seeing that every day? And the goal here is to protect the alpha, the potential alpha generation that these portfolios could offer,
especially as they get bigger. Now, the Presidian model in particular uses a kind of blind trust approach where only the representative knows the exact holdings,
yes.
While other ant structures use, for instance, a proxy basket. What's your thinking on the merits of the blind trust route versus the proxy basket? In both cases, how certain can you be that the spreads will be tight?
So one, let's start off with what you call the blind trust. So remember, there is some information out there. It's not just the AP representatives or the authorized participant representatives that know the holdings. There is something called the VIIV, which is published every second. So unlike a mutual fund, you'll be able to see the value of this portfolio every second. And because it's US-based securities, you'll be able to see within a good reason of what it's actually worth. So you can determine when you want to buy and sell. So it's not totally non-transparent. There is some visibility. But what I think you get from that is it allows a portfolio manager that's comfortable sharing anything to put something into that portfolio that they feel confident no one, as I said, can front run or free ride, and really look forward to that comfort zone of that product and put forth their best ideas forward. And that's kind of what we're doing. We want to offer our best structure and be vehicle agnostic. There are clients who prefer mutual funds. There are some that prefer ETFs and, quite frankly, SMAs.
Now, speaking of mutual funds, I want to get your thoughts on pricing as well, because you already have an American Century Sustainable Mutual Fund, and you have an ETF version of that. The mutual fund institutional class charges about 75 basis points. When you price it, when you price the ETF, that is, are you thinking about appealing to the mutual fund customer, or are you thinking about getting the ETF customers to basically pay up?
So no, the way I would word it is when you think about how you're going to price, and I can't tell you what the pricing is yet, but how you're going to price, what you're looking for is you want to price something that's fair for the value you're offering. You don't want to underprice yourself, and yet you definitely don't want to overprice yourself. So what I would tell you is you definitely want to price something that's fair and in the range for that value. And if you look at some of the other structures that have become public, everything's going to be roughly within the same ballpark, I think. So obviously I know what we're charging, I know what some of the others are charging. I don't think you're going to see anything at 90, and I also don't think you're going to see anything at 10. I think there's going to be a range where they sort of all fall between, but hopefully we'll be in there when we share what we're doing.
Okay, so it'll be clustered. Speaking of pricing, American Century has a line of ETFs under the Avantis name. They're active, cheap, and transparent. They're run by a former Dimensional guy as well. Why not just stick with this route instead of going the active non-transparent route?
So if you think of what they're doing, right, they're using an academically time-tested approach that's been proven to work in the past, and they're continually improving. And then you look at the number of holdings that they own, I mean, you're talking AVUS probably has 2,000 to 2,500 holdings. That's very different than having something that's 40. Now, they're very different than what American Century has traditionally done. If you look at American Century, it is a fundamentally based shop that does a bottom-up approach and does stock picking from that. And so when you look at what they do, so going transparent on the Avantis lineup, those gentlemen that we hired, makes sense for what they're doing. If you look at what the rest of American Century does, we want to bring forth all of our products, not just one set or one fragment. You want to bring forth all of it.
Got it. Now, you used to work at Vanguard many years ago. The firm announced it'll launch a private equity fund for institutional investors. Very quickly, I just wanted to get your thoughts on what the strategy might be here.
I mean, I'm not sure what they're thinking about. I mean, for someone as big as Vanguard or anyone that big, you have the opportunity to test the market and see what works. And I think if you have the ability to test, incubate, no matter who you are, what size you are, if it makes sense for your firm, it can make sense for the clients.
All right, sounds like Vanguard is diversifying then. Thank you so much, Ed Rosenberg of American Century Investments. Now coming up, we take a ride on an aerospace and defense ETF that has survived all the turmoil surrounding Boeing. This is Bloomberg. I'm Scarlet Food. This is ETF IQ. Now, for every ETF that targets a region or a factor, there are usually others doing the same. And if the everything rally falls apart, where would you go? GMO proposed emerging market value stocks. Invesco has a fund that fits that bill. And John Frank, Invesco's equity ETF strategist, joins us from Chicago. Before we get to him, though, Eric Balchunas is going to give us the drill down into that fund, PXH. Eric?
Thank you, Scarlett. Yes, this is the fundamentally weighted FTSE RAFI Emerging Markets ETF. It's kind of an early day smart beta ETF, launched in 2007, but essentially looks at EM stocks for cash flow, dividend sales, book value, just so it leans value. Pretty big, 1.4 billion is pretty big for this. Let's look at the cross-section and the country exposure you get here. And you notice China's about the same as like the broad EM index, but you're going to get a lot more Brazil, a lot more Russia, and you're not going to get South Korea. So different weightings there. But look at the PE. The PE is 10, right? So in a world of sky-high valuations, that is definitely on the low side. Let's look at it versus IEMG, which is the big EM index. And obviously you can see here that it's way smaller, way more concentrated, lower PE, and also the one-year return is going to be a little lower. So look, this is an ETF that when it works, it should kind of pop.
The only problem is it hasn't for a bit. Now, still with us in Chicago is John Frank, Invesco equity ETF strategist. And that goes for EM as an asset class or as a region on its own. There's a theory, John, that the reason value has underperformed is because there's little to no inflation. Value is usually a bet on energy and finance, which tends to need higher inflation. Do you see that linkage? And if so, what's the inflation outlook for EM?
Well, when we think about the EM exposure, we really think of PXH as looking at almost a value within value. So, some of those PE ratios that Eric just went through, when we actually look at the long-term 10-year discount, we see EM trading at a 30% discount as opposed to its 12% normal. And we actually look at PXH at 50% discount. We think about when value comes back, that strategy should be positioned well because, again, the way it weights the portfolio, the methodology really severs the link between price and market weight in a portfolio. So traditional cap-weighted strategies are going to increase their portfolio weight as the price increases. But what we're seeing is other fundamental factors are actually impacting the portfolio weight in the strategy. So as a result, you see that valuation increase. In terms of what the catalyst is going to be, I think there's a safety margin there. So we're talking about could it go lower from 10? That's definitely possible. So I don't want to say that going forward the PE ratios are going to increase. But I think you think about the safety margin in terms of decreasing from a base of 10 versus 15. If you look at the standard EM asset class, or even you look here in the U.S. at above 20 times, I think that safety margin value really provides investors with a cushion going forward. Now the catalyst, but it could be inflation or other strong economic growth, whether it's earnings. I think going forward it's positioned to do well when that catalyst does appear.
Another one of yours, John, that's been very beat up is the oil and gas ETF, PXJ. Not only has it had a bad decade, but it's getting beat up in the media with all this ESG hype, yet everybody's still consuming a lot of oil last time I checked. What's the bull case for an ETF like this to come back?
So it's going to be really sensitive to the price of oil. Right now, we look at the ETF's history going back almost 15 years. It's actually the largest spread between the price of oil and the price of PXJ. So for the oil, sensitivity to oil is going to help. And then just, again, valuation. This is going to be in talking to clients, energy is an unloved asset class within the S&P 500. It was the worst performing asset class of the decade. Specifically, you look at PXJ's tilts, not only value, but small size. I think the S&P small cap 600 energy sector was down 10% annually, over 10% annually over the last decade. So it's a mean reversion play. And again, when we look at price to book value, about 0.62 times, that's the lowest I see on my port function when I pull it up on my Bloomberg, the lowest over the last, call it 10 plus years. So in terms of, again, mean reversion play, when oil does, if and when it does bounce back, PXJ should be well positioned to play that rally.
All right, a mean reversion play for both oil and gas and perhaps for EM value as well. John Frank of Invesco in Chicago, thank you so much for joining us today. Now, the ETF industry has something for everyone, including those bracing for more global tension and conflicts. In this week's There's an ETF for That, we highlight how defense can make for good offense. With geopolitical tensions here to stay, the U.S. government is not holding back on defense spending. The SPDR S&P Aerospace and Defense ETF gives investors a modified equal-weighted exposure to the sector. Trading under the ticker XAR, the fund consists of mainly large caps with a mixture of mid and small caps. Despite Boeing, one of its notable holdings, struggling over the past year, XAR has had a smooth flight when it comes to returns. In addition to Boeing, the fund holds more than 30 names, including Maxar Technologies, Lockheed Martin, Northrop Grumman, Aerojet Rocketdyne, and TransDigm. XAR has roughly $2.25 billion in assets and an expense ratio of 35 basis points. Long-term, the fund has trounced the S&P 500, even with the benchmark's record rally. XAR gets a green light in the Bloomberg Intelligence traffic light system, with one warning for its weighting system. We're both Gen Xers, so we both like that little moon man. It reminds us of MTV.
Yeah, absolutely. And this is interesting. This is one of those ETFs that was early day, but now they've evolved. Now there's space ETFs, UFO and RCKT, which are doing this, but just the space part of aerospace and defense. So the evolution continues.
Maybe space needs to be highlighted on its own. Aerospace, defense, and space ETF.
Yeah.
All right, that does it for Bloomberg ETF IQ. Be sure to catch us each Wednesday at 1 p.m. New York time, 6 p.m. in London. From New York, this is Bloomberg.